Hi class, hope you're doing well. I'm going to work through two problems today. I may split them on two videos. I'll see how long it takes me to do. I am looking at exercise 8-4 on page 377 of your wild text. We are going to calculate depreciation using the straight line method. Okay, so it says this is exercise I'm doing 8-4 right now. Okay, so Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $43,500. Okay, let's get that down. $43,500. The machine's useful life is estimated at 10 years, okay? 10 years, or 385 units of product. I'm just working on straight line right now. With a $5,000 salvage value. Okay, 10-year life. Determine the machine's second year depreciation under the straight line method. The straight line method means that we depreciate it evenly across the years of its life. Now, if it happened in the middle of the year, we would actually calculate a year's worth, and then on that particular financial statement, we would only use however many months times that year. Okay, so in this situation, my calculation is going to be $43,500 minus the $5,000 salvage value, which equals $38,500. Divided by 10 years is $3,850 per year. So that means per 12 months. So if we bought this in the middle of the year, we might just use half of that. See, we would just use half of that. Okay, now, what's really important is what to do when we get ready to sell. Like I told you in my narrative, we have to show, we always end up showing, almost always, a gain or a loss when we sell a piece of equipment. And it may not feel like a gain or a loss. It may feel like a total loss to you, but it's really a gain, and it's because maybe you sell the equipment for a whole lot less than you paid for it, but if you've been depreciating it every year, you've written it down to a net book value that you end up sometimes getting more for it or less. So hop over and take a look at exercise 8-16, which has several calculations for us regarding selling a piece of equipment. Okay, or getting rid of a piece of equipment. Okay, so Diaz Company owns a milling machine that costs $250,000 and has accumulated depreciation of $182,000. Okay, so its cost, which is what is in the equipment account, is $250,000. It has accumulated depreciation of $182,000, which means it has right now a book value. When I say book value, I mean its cost, which is in the equipment account, minus the amount in the accumulated depreciation account, gives us its net on our books. That has nothing to do necessarily with what it's worth. This is just what we've written it down to. So it has a book value of $68,000. Then item 1 says, what if the machine needed extensive repairs and it's not worth repairing? Diaz disposes of the machine, receiving nothing in return. I'm going to calculate this two ways. I'm going to calculate it directly, and then I'm going to show you how to get the gain or loss by doing the journal entry. Okay, so we're going to calculate the amount of gain or loss and then we are going to do the journal entry. Okay, if I have a book value of $68,000 and I receive 0 for it because I throw it away, book value $68,000, then I have a $68,000 loss. Okay, here's the journal entry. I've got to get the accumulated depreciation off the books. Debit accumulated depreciation. Credit equipment. I've got to get the equipment off our books. We didn't bring in any cash or anything for it. So to balance this entry, I have to record loss on disposal of equipment, $68,000. There's my balanced entry. Okay, let's hop over here and look at number 2. Number 2 says Diaz sold the machine for $35,000 cash. Well, if I received $35,000 and my book value is $68,000, I still have a big O loss, right? So my entry is going to be, go back up to here to our core information about this problem. Debit accumulated depreciation. To get it off our books at $182,000, credit the equipment account to get it off our books for $250,000. Debit the cash we received of $35,000. So now what it takes to balance this entry is a smaller loss than in number 1. Loss on disposal of assets. You know the drill. Okay, are you kind of seeing a pattern here? Okay, let's look at 3. 3 says, what if we sold the machine for $68,000 cash? All right, so we received $68,000. We have a book value of $68,000. We have no gain or loss. In this situation, our entry is going to be same old thing. Accumulated depreciation, $182,000. Get the equipment off the books, $250,000. Take in cash of the $68,000, and see, this entry balances. This entry balances, so there's no gain or loss to record. Okay, let's do the last one, number 4. Number 4 says, what if we sold the machine for $80,000 cash? Okay, so we received $80,000, and we've got a book value of $68,000. So we've got a gain of $12,000. Okay, so how would we record this entry? Well, same old thing. Get the accumulated depreciation off the books. Get the equipment off the books. Take in the cash of $80,000. And now we've got to credit a gain on disposal of assets of 12,000 to make this thing balance, see? And gains are credits. All revenues are credits. Okay, so see, that makes perfect sense. Okay, thank you.